Hello, everyone. This is Sebastian McMahon from IA Financial Group, and I'm back with another weekly economic review, this time for the week ending May 6th, 2022. So a very volatile week on the markets. So if you look at the returns, negative for bonds again. So we had the Federal Reserve, so the US Central Bank, hiking its leading rate by 50 basis points. So that's pretty much twice the usual pace, and it pushed rates higher, meaning that we have losses on bond portfolios on the week, minus 2.25% for the long index, minus 20% year to date. And in the benchmark that is most relevant to your portfolios, the universe one, down 1% on the week and minus 11% year to date. Stock market was mostly negative, except in the US, even though we had the pullback on Thursday. After 4 days, we still had gains. But as I'm recording this on Friday morning, markets are yet to open, but they're pointing lower. So let's see where we end up when the day's said and done. Oil higher, Canadian dollar higher, gold remains volatile. So this week we had the job reports on both sides of the borders coming out. I'll be jumping over these two because I want really to focus on the Fed and the market reaction and what's priced into the markets. So as you can see in the chart here, that's the first 50 basis points hike that we've had since 2000. So it's been close to 22 years since we've had such a strong rate hike. Mr. Powell said many things. He did acknowledge that it's not going to be pleasant as the Fed is going to be hiking, but it's in the long run, I mean, everybody will be better off. So that's kind of the thinking that the central banks had. But there was a strong positive reaction for equities following Mr. Powell's press conference, because Mr. Powell kind of pushed off of the table the idea that we could have a 75, so a 3-in-1 hike in the next few months. So the markets thought that, well, maybe we're removing some tail risk here. Maybe they're not going to be as aggressive as we thought. But in the end, the following day, I mean, we had a reversal, and quite a reversal. So if you look at the charts here on the left, you had the reaction on Fed decision days. So going back all the way to 2010, as you can see, the reaction was very positive. We had 3% plus returns on a Wednesday, and that was one of the best Fed day reaction since 2011. As you can see on the right, also on Thursday, we had one of the worst contractions ever for the S&P 500. So both extremes. So having such a strong return, 3% plus, followed by such a strong contraction of 3% plus in 2 consecutive days. You don't see that often. You usually see that in crisis periods, just like in March 2020. And also you saw that in 2008. So quite a volatile week. So the market is really looking for answers here. And one of the things that that pushed the markets lower on the Thursday was the news that unit labor costs, so the cost of having employees, hiring them, just paying them, went up by 11% in Q1. So that's a sign of inflationary pressures coming from labor. So it's a serious issue. And also productivity going down in Q1 quite a bit. So prospects for economic growth being a bit dimmer here. So when you put the two together, I mean, that gives you a kind of a pessimistic outlook out there, and that's why we saw such a strange change of hearts, such a strong change of hearts here for the markets on the Thursday. So when you look at surveys of business owners and households, so as you can see here on the left, the NFIB Small Business Optimism Survey, when you ask business owners the outlook for general business conditions over the next 6 months, as you can see, they've never been as pessimistic as they are right now since we had the data going back to the 1980s. And on the right, when you look at household confidence, well, if you ask them about how they expect their change in their financial condition in the coming year, well, as pessimistic now as they've been since the recession of the early 1980s. And usually you see such low levels in recession periods. So that tells you how low the morale is. And when you have downbeat businesses, downbeat households, you get less prospects for investments, for hires on the business side, and less prospect for spending for consumers. So that pushes the economy to a slower pace, and the risks of a technical recession are clearly rising right now. So if you look at what's coming if next for central banks, so here two kind of spaghetti charts, but it just shows how many hikes are expected, how many 25 basis points hikes are expected for each of the next meeting dates in the US on the left and Canada on the right. So on both sides of the border, 450 basis points hikes, so 4 consecutive hikes of 0.5% are expected for the next few meetings. So there's still a lot of hawkishness that's priced into the markets here. So the train has left the station, and this train will continue to chug along. So maybe ending on a positive note. So if you look at seasonality right now, the 30-year bonds, usually their seasonal pattern is that you have some pullbacks at the beginning of the year, and then starting in early May, you have a strong window of strong performance, and we just entered that window. So seasonality is just, I mean, it's looking at the past, so there's no guarantee that it's going to happen any given year, especially in 2022. But I mean, with the strong pullback we've seen this year for long bonds, there's some reasons, if you just look at history, to think that maybe we could have some relief during the summer months. So we don't base our strategies based on that, of course, but it's one thing, let's say, that we can put a check in the plus column here for holding long-term bonds. So that's what I wanted to share here. So we remain on the defensive side in our portfolios. We removed some equity exposure over the last few weeks. We did some more this week. We remain nimble. We remain underweight on bonds. We're pretty close to neutral because we're seeing lots of volatility. So taking bets right now is not the right time to be taking some strong bets. It's time to manage risk. It's time to protect capital. And when we see an opportunity or turn around the markets, we'll be able to use all of our tools to be as active as we can be. But right now, it's not a time to be opportunistic. It's a time to be defensive. So what to watch next week in Canada? We'll have building permits. In the US, we'll have inflation, and we should have for the first fall in inflation in a while. So we had 8.5% year over year in March. Should have 8.1% year over year in April. So the base effects are at play here since inflation started to accelerate starting in April last year. Well, the year over year comparison will start to push inflation down, and we'll have the reading of consumer confidence from the University of Michigan should keep on sliding lower at 63.5 in May. So that wraps it up for the week. ia.ca/economy. You'll find everything you need there. Economy and Finance 101. I made some material about central banks, how price of bonds move compared to interest rates. So if those are still some concepts that you need some help with, there's some videos for you there, and you can follow me on Twitter and on LinkedIn. So thanks everyone, and I'll be back again next week.